Welcome to Streams to Impact, the podcast where busy professionals are empowered to develop multiple streams of passive income built on solid, secure, hands-off commercial real estate investments. This show is not just about wealth development. Every episode, we dive deep into inspiring conversations with professionals who are living life to its fullest while making significant and meaningful impacts on a world in great need. Engage with us each week and discover how you can thrive and flourish abundantly in all areas of your life. Now here's your host, Dr. Allen.
Hello and welcome to Streams to Impact. I'm your host, Dr. Allen, and we're so glad that you can be with us today. Our guest today is Jake Clopton, and he is a serial entrepreneur, author, and economic specialist in real estate and finance. He founded Clopton Capital in 2009 to provide efficient access to debt and equity for commercial properties. Jake also owns Clopton Insurance Services, a nationwide insurance agency and several apartment communities in Chicagoland. He is the author of Commercial Real Estate Investing, and he contributes regularly to publications like Benzinga and National Mortgage Professional. Jake has appeared as an expert guest on shows such as Good Morning Chicago and The Viewpoint with Dennis Quaid. So welcome, Jake.
Thanks for having me on. Appreciate it.
Take us into the show, would you? And just let's start off with let's talking about the macro trends that you are seeing in commercial real estate and what's going on there on the macro side.
Well, the biggest story on the macro side is rates right now, right? Mm-hmm. I think we've hit peak rates and we're starting to come on the downslope now. You know, we just had a rate decrease. I think we're going to have to see, like, you know, what the path of rates ends up being and how quickly those come down. But, you know, I do think now is a great opportunity that now that the cost of capital is, you know, has gone up and now is starting to come down to kind of find an entrance into a lot of real estate assets. You just get that, you know, lower cost capital cap rate arbitrage thing going on. And, you know, now would be the right time to start looking for investments. Just the lower cost of capital alone is going to push property values, you know, higher, but you're going to get a lot of, you know, other demographic and macro trends that are going to help push values up.
Yeah, it's just been a strange markets over the last several years here.
That's a good way to put it. Yeah, first COVID, now this. Yeah, so I agree.
The trends did not really trend as predicted in most cases, I would say.
Right. The trends weren't trending. I guess that's a good way to put it. You know, there was such a run up, you know, during the teens. And, you know, everybody, I guess, was wondering when that was going to come to an end, right? COVID didn't necessarily stop the trends. I think COVID actually exacerbated a lot of those macro trends because it just injected so much liquidity into the system. I mean, it certainly didn't help office, right? But that's a different story. But really, it was, you know, the Fed raising rates that, you know, brought a lot of those trends, like, you know, like multifamily rent growth to a halt. You know, that said, you've still got the right demographics in place for multifamily housing. You just have a huge, you know, supply constraint, and, you know, you've got a growing population, and there's a huge lack of housing out there. But you know, we have to start looking at things more in like localities than just like overall picture for the entire country, because, you know, if you look at just the Sun Belt region, for instance, they had such a run up in rents, but that's the place where I've seen a lot of the trends weren't trending the right way, right? You would have thought anywhere in Texas or something like that, you know, those deals would have worked out. But a lot of people ended up buying when things were pushed already and the expectations of rent growth didn't pan out. That's why a lot of those properties are, there's nothing wrong with some of those properties, right? They just got into high leverage debt, and you know, some of the rent growth didn't work out. So I've seen a lot of that, and that's a good example of the trends not trending.
And short-term loans.
Yes, when you get high leverage short-term loans, and you know, the economics of your deal don't work out to what your pro forma thought, that you get in a tough spot.
And saying that the trends didn't work like they were projected to work is that so many people, unless they found themselves in actual difficulty with short-term loans and they had to do something, most sellers were holding on to the teen prices, whereas there just wasn't a market for what the sellers were wanting.
Right.
And the only sales that were coming through were distress sales.
Right.
And is that going to change? Or are buyers' expectations going to have to change?
Yeah, it's a good question. It's basically the bid-ask spread, right, between where sellers want to sell and where buyers want to buy. And the difference between buyers and sellers is, you have buyers who on the one hand have a very high cost of capital. And at the end of the day, commercial real estate is just a math problem. If the cost of capital is really high, you have to come in with more equity. And that can be really difficult. And so realistically, what that ends up translating to is, lower bids on their side where they can actually make these deals work with what is in place today. On the flip side of that, you have sellers who are saying, well, the cost of capital is going to come down significantly over the next year. And the value of my property should be higher this time next year or 2 years from now than it is right now. So if I want to sell, if I'm not forced to, I'm not gonna take some lowball price just because a buyer would need to come in with more equity. They'll just wait. So you have that kind of cat and mouse game going on. At a certain inflection point, either the underlying economics of the properties are going to catch up to where the cost of capital is, or the cost of capital is going to lower to where the economics of the properties are, to have these two parties meet in the middle. But right now, we're still, the rates are pretty high. And they came down a little bit, but they're still pretty high, and that's where the challenge is really.
Yeah, and so many things going on geopolitically. A lot of uncertainties still remain, even though I think the interest rates are projected to continue to decline.
Right.
But
That is absolutely right. I mean, I don't think I think a lot of people in the real estate industry understand how geopolitics can play into some property located in Chicago, right? But when you look at what your cost of capital is based on, right? It's based on an index, which is, treasuries, and treasuries are an international product. So, yeah, very much so what happens on the other side of the world can affect your deal because those indexes will get affected. I mean, exactly what we saw going on, with Russia and Ukraine and the inflation that caused and how that affected the 10-year and all this stuff. So, I mean, that's just one example. But, yeah, I mean, you're absolutely right. I mean, keeping an eye on, geopolitics is definitely a good idea, especially when you're going to be tied to, or the 5 or the 10-year treasury rates.
Yeah, and then on top of that, an election year.
Yes.
Just a lot of questions.
Yeah, there's a lot of uncertainty out there, and I feel like a lot of people think there's some black swan event out there that's going to cause the market to crash, and I don't know, maybe, right? I mean, the thing about it is you don't see it coming. I don't know, but it's hard to, I guess, prepare for that or operate under the assumption that it's going to happen. I think you put in place today, with the way things are today, and then also protect yourself against something like that happening.
As best as you can, of course, living through
as best as you can.
2008. I guess I'm probably more leery of those black swan events than some people are.
Oh yeah. Yeah. Well, I mean, just think about everything that's happened since 2008. It's like every couple of years something happens now. So.
Well, in looking at, and I mean, really, all we can do is to look at past trends and base our assumptions really on the fact that these trends have been trending really for the last 100 years, and it would take a really, really black black swan to change things considerably. So
Right.
all we can do is to go on those assumptions there. So looking at those assumptions, what segments are outperforming? You mentioned multifamily, the housing shortages still seems to be one of the better segments. What is your take on the overall look at the various different segments?
Yeah, I think for most people, especially those that want to be like limited partner investors or something like that in like a real estate deal, multifamily is probably going to be the safest bet, right? I mean, all the demographics and all the economic trends point to that being a pretty safe bet. There's other sectors, where you can get higher yield. I don't know if I would suggest that like a lot of people be limited, kind of like silent partners and stuff like that. Like some of the things we do are areas that like private equity funds are chasing, right? Like self-storage, right now, membership style car wash deals. Those are areas where I see like a lot of private equity funds, chasing those properties to grow portfolios. I think there's a lot of opportunity there, but those are much more complex deals, right? I mean, those are operating businesses, and multifamily is too. But I would say, multifamily is much more stable generally, just, throughout the country than some of these other more, specialty property types. But you can get outsized returns in those, those types of deals. But with higher returns comes more risk, right? So I would say for most, kind of solid investors or people that want to be limited partners or get involved in like syndications, probably stick with like multifamily. And or there's probably some industrial deals, where you have like a credit tenant or something like that, can be really lucrative as well and pretty safe. So I'd say probably those two areas is probably like the best bet right now.
Well, what are you seeing in terms of apartment as opposed to mobile home parks, both multifamily segments? What do you see the difference there?
I mean, I would probably classify, mobile home parks as, part of just the habitational area. It's a little bit more specialty though, right? Those tend to be in not as highly populated areas and, a little bit different demographic of people. But I've seen, some operators do extremely well. That said, I think it comes down to who you're investing with, right? I mean, if you have an operator that specializes in mobile home parks, okay, cool, great. They've done 10 deals or something like that. They really have the expertise to manage that type of asset, and they're not somewhere completely across the country and just going to throw a third-party management company in there. I'd say that's probably something that I would be interested in taking a look at. If it's some guy who sees a mobile home park because it's got a good cap rate and he wants to raise some investors around it, and he's in New York City and, it's in Alabama and they're going to put a third-party manager in there, and I've seen this exact scenario, right? That's something I'd be a little more leery of. Mobile home parks, I think it does take the right operational expertise to do that type of stuff. It's a little bit of a different asset, but it's still habitational. It still get the right demographics going for it. But some of those are in pretty out there areas, So I'd be a little bit more careful with those than I would just your typical, apartment building.
Yes, as you get into the tertiary, the secondary even, but certainly the tertiary areas, contractors are just not as reliable.
Right.
And you're just kind of at their mercy in many situations.
Right.
So that's my concern.
Right. You do also get into the whole like who owns the house, right? I mean, typically, mobile home parks are really you own the land, the lots, and the hookups, and you try to lay off that mobile home to whoever the tenant is, and or have them buy it and put it on there in the first place. But I see a lot of guys go into there and own those, and that's one aspect of it that I think a lot of investors going into it wouldn't realize, that you can't really take that home rent, into account when you're valuing these properties. So there are a few like different aspects when it comes to mobile homes than there would be just for a typical multifamily deal that some people may not know or realize going into it can affect the value.
Yeah. What about RV parks?
That I would not throw into the, habitational area. I really consider that almost more like hospitality, right? I mean, that's the RV park. I mean, that thing can just flat out just drive off. And that's really more of like a vacation type of thing. Although I know some people, that's a lifestyle for them, and they go and live at RV parks, but that's a much more of a different animal. Especially when you have a property, for instance, where it could empty overnight. It's certainly a different animal.
Right. Yeah. What segments would you just absolutely stay away from?
What segments would we absolutely stay away from? I think for most, investors, getting into property types that I kind of view as more business than investment real estate, unless they really understand what they're doing, probably stay away from it. And like, there's a couple I would throw out there, like hospitality, like hotels, maybe even assisted living facilities, stuff like that. I think a lot of people got into those types of properties while back thinking that like, hey, this is investment property, when it's really more of an operating business, especially in the the assisted living, memory care side. There was so many of those I saw go up, 10 years ago, and right, I mean, everybody thought like the demographics of these properties were certainly in the way. We have an aging population, all this stuff, and they're very much so needed. The challenge with, properties like that is controlling the expense side. I saw a lot of, again, just for example, assisted living facilities lose money, even though they were, close to fully occupied, because the expenses just got so far out of control, or they were mismanaged. So when you're dealing with property types that are more of an operating business, you have such an operational risk, for the business, and it's very much so dependent on who your sponsor is and who's operating that property, rather than just, hey, it's a building and there's also operational risk here as well, but it's leases and it's a little bit more stable. So those are probably property types that if in sectors that I would tell people probably stay away from if they're looking to be like silent partners, unless they really understand what they're getting into, because you have a different type of risk with that type of stuff.
Well, that's pretty much my take on it as well. What about student housing?
Student housing, again, habitational, but it is again a different animal. When you're dealing with just students and typically 6-month leases, I think if you're in the right spot with student housing, it can be a great investment. But again, I've seen a lot of these student housing deals that worked great for a couple of years, but then that market got incredibly oversupplied, and now they're struggling. So that's a completely different demographic set, and it's so much dependent on wherever it's located and whatever university it is. I would be really careful with that as well. And if you're going to get involved in student housing, kind of stay with only some of the top tier schools, because we've seen so many smaller universities either disappear or struggle with enrollment, stuff like that, especially since after COVID. And a lot of them are saddled with a lot of debt. So I mean that's something I would definitely be careful with.
Yeah, and I mean, if it's specifically student housing, it's usually constructed for joint living,
Exactly.
and it's converting it to any other type of housing would just be almost impossible the way that they have constructed those.
Exactly. I mean, it's built to be rented by the bed, not by the unit.
Yeah.
Right. And there's
Exactly.
there's specific layouts for it. Probably not something I would recommend for most investors.
Yeah. And then they all also they come furnished, and I can't imagine really the expenses of trying to keep up with that. I mean, to keep them rentable, particularly in a competitive environment, you'd have to be replacing those furnishings
Oh yeah.
on a fairly regular basis.
Yeah. Yeah. I mean, it is a lot of management and like operational side too. Manage that many different leases and tenants and get it re-tenanted every 6 months, right, with the semesters. It's a little bit more challenging than your standard multifamily. Yeah.
Is multifamily where you see really the greatest opportunities, or is it, you would say it's the greatest opportunity with the greatest risk mitigation.
Yeah, I mean, I would say it's your best risk-adjusted return. But then again, in you know, multifamily, there's still, you know, you still have to be careful, right? I mean, I see probably the greatest opportunity in like workforce housing for multifamily. I think a lot of the Class A stuff got a little bit overbuilt, you know, and also we're potentially going into a challenging economic period, and that type of like really expensive Class A housing rents is probably going to be challenging for a lot of people. Whereas, you know, in workforce housing, you can have kind of that like transitory effect of, you know, Class A people coming down to it, or, you know, maybe like Class C properties coming up to it. So you have potentially a lot of like people moving in and out of that sector. The other thing to pay attention to a lot would be, you know, just geography and like the local demographics of where you're dealing with, right? I mean, going into, again, an area like Sun Belt, Texas, where we saw a lot of people move and lots of population growth, may not necessarily be the best deals. Maybe rents, you know, have hit their high and they're stagnated now, and or there was, you know, just too much supply. So, you know, I mean, really, you still, I think it's, you know, you start with like a funnel, right? And like you got the top, you got your, you know, your really good demographic economic trends of the sector, and then you can, you know, drill down to the right property, going from like geography, property, you know, sector, multifamily, stuff like that. And you have to pay attention every step on the way down. But I still think, you know, for the, you know, most investors that want to participate in like a syndication or invest into a deal is probably the best bet.
Well, we are talking today with Jake Clopton, and he is the founder of Clopton Capital, which does a number of different things. They are a finance company and an insurance company. And as you can tell from our conversation, Jake has a lot of insight and wisdoms to help us out in conjunction with these things. So Jake, give you a moment here to just tell us a little bit about who you are, how you got into the finance and insurance industries, and tell us about Clopton Capital.
Yeah, so I started this back in like the 2008-9 era. Before this, I traded interbank hedging product futures, like 3-month LIBOR, Fed funds, stuff like that, here in Chicago. And as you all know, that disappeared pretty much overnight. So try to figure out a way to, because of credit crisis, connect people, well, borrowers with capital providers. And that's what we do now, right? We're an intermediary connecting deals with capital. We started the other verticals. We're an insurance company. We're also sales brokerage. We're 1031 qualified intermediary. And we do commercial solar installation. We started those because it's all the same people, right? So we started, you know, kind of expanding from being just a capital markets firm to more of a commercial real estate services firm, so that we can offer the people that we're already dealing with, you know, different, you know, service aspects of, you know, for the assets that they're either acquiring or about to acquire. So, you know, we'll probably step into one or two, maybe two other verticals. As far as, you know, insurance is another really interesting thing that I'm sure everybody has realized is, you know, going up a lot, and probably going to continue to go up a little bit further. So our insurance agency has really been helping out a lot of people, because we're 100% focused on commercial property, and most, you know, most groups out there are not, right? They'll do like everything: your house, your car, you know, workers, all this stuff. So we take kind of the same approach, where, you know, usually your typical insurance guy will, you know, just give you renewals and not really shop it or not really access many markets. You know, we take the same type of like wide net cast approach that we do on the capital market side to find the best deals, and approach every market we can. So that's really us. We probably are going to add, you know, a title service here in the next couple of months. But that might be it, because that's kind of a lot already.
Yeah, that sounds like you got your plate full there.
Yeah, there's a lot of good people that work with me that handle the other sides. I still do all of our day-to-day on the capital market side. We just brought on another guy that is heading up our equity side, and I'm focusing on primarily like first lien and like you know, higher cap stack sub debt type products.
Okay. Well, you can find Jake at cloptoncapital.com. And as you can see, lots of services there that they provide real estate investors. Jake, talk to us a little bit here about how are the various capital sources different, and how do they affect different investment opportunities?
Yeah, so we use banks, credit unions, life insurance companies, private debt funds, private equity, government agencies, pension fund, basically any capital provider that's out there, right? And the way that all know which one is a fit for any deal is really trying to understand things from like the equity down, meaning like who are the sponsors, how is this thing put together, right? I mean, there's a big difference between a deal that's just one guy and he owns everything versus a deal where it's syndicated and it's one general partner, but then let's say like 100 different limited partners in the equity stack as well. What that comes down to is the difference between like is there recourse available for it, meaning like a personal guarantee, or does it need to be non-recourse? That in itself will give you a good direction, and then a step down from that is really understanding like the strategy of the property, right? Is it a value add deal, or is this just like a stabilized acquisition type of deal? Usually, a value add would be, if you're going into a property and performing some sort of turnaround, either operationally or rehab. Usually we end up in the private debt fund space. Debt funds tend to be like your shorter term, higher leverage, like easier underwriting type of, capital stuff that like, banks and depositories don't necessarily like to do. If it's more of a stabilized deal and we're looking for, like long-term, low fixed rates, we'll end up with either banks, credit unions, or maybe like, Fannie, Freddie, or life insurance companies, something like that. So really understanding like really the equity, then the property, and then what each different capital source, what their money wants as far as like returns and duration, kind of gives us an idea of, who the best players and capital providers are going to be for any deal.
Well, Jake, for those of us raising capital, what are the different ways we can go about raising capital, and how do we do that?
On the equity side, right, there's a couple different ways to go. And the main difference is it a joint venture or is it a real estate security? And I think you have to be really careful about that also, because if you start getting into the real estate security space, you've got a lot of regulation you need to deal with. Joint ventures, that's more of a partnership, and that's not a security, right? The people, and the biggest difference is, do your investors have a say in what's happening, right? If they're silent investors, that's a real estate security. That's like a Reg D offering or something like that. Even if it's not a Reg D though, like the makeup of like the investment still kind of dictates whether it's security or not. Mm-hmm. If you're doing joint ventures, right? I mean, you can go directly to private equity funds, use someone like us, to get access to stuff like that, family offices. If it's a real estate security, you really need to either do a Reg D or go through a broker dealer, registered investment advisor, something like that. So if you're going to start raising money, the first thing I would really understand is what type of money are you trying to raise, and then what type of regulations around that money there are. And that'll give you an idea of who you need to go to, right? I mean, can you go to just a capital market guy like us to find joint venture, or do you need to go to a broker dealer, to sell securities? That's the biggest place to start, and that'll tell you where you need to go.
All righty. Well, Jake, thank you so much for being with us, and viewers and listeners, thank you for joining us today. I know you found our conversation to be engaging and informative, and we look forward to seeing you in our next episode.
Thank you for tuning into Streams to Impact, brought to you by Steed Talker Capital, a company empowering passionate professionals like you to develop multiple streams of passive income built on solid passive real estate investments. As a significant part of our endeavors to make a cosmic and meaningful impact for this world, Steed Talker Capital contributes significant portions of our profits to activities and organizations committed to better understanding the equine. These endeavors attempt to enhance the treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures great and small flourish abundantly. If you are ready to learn how our passive investors have earned an average 33% annual return on their investments, schedule your complimentary passive income to Prideful Impact consultation. Obviously, we cannot continue indefinitely to offer these valuable consultations for free, so grab your passive income to Prideful Impact consultation while you still can. Go to steedtalker.com/passive